all the great cities of the world, they're all the nexus of an empire. Venice was a nexus of an empire. Rome was a nexus of an empire. And when the empire flourished, the city flourished, and they built great buildings, and you can see them manifest themselves in the architecture. And then when the empire failed, right, the city calcified and fossilized, and started to sink one way or the other. So let's look at Bitcoin. Well, Bitcoin's the greatest city in cyberspace. The difference here is, you don't need 25 great cities in cyberspace. You definitely need one. But if you're a wealthy business, if you're an asset holder in Beijing or Tokyo or Moscow or London or Paris or Rio or New York or California or LA, all of them can park their money in Bitcoin. And so in that regard, being the greatest piece of real estate in cyberspace is an advantage. The other advantage is there's only 21 million city blocks, whereas if you look at New York City, they can develop that and they expand it out to the boroughs, to Queens and to Brooklyn, and there's zoning and you could build up, and there's no, there is some scarcity to the acreage, but there isn't necessarily the same scarcity to the square footage, and it's uncertain and it's very political. And because it's very political, it meant that it was dilutive, and you could be dilutive or you could be in. Bitcoin is advantageous because the 21 million blocks are probably capped there for 10,000 years. And if you own a block of Bitcoin, you could rent it out to any bank or a counterparty anywhere in the world at the prevailing market rate. And the mayor of San Francisco or New York can't rent control your block of Bitcoin. So that's another big advantage. In terms of speed, you got to keep in mind, like 10,000 companies could buy $10 billion of Bitcoin each and just hold it on their balance sheet. And then, the network would be worth $100 trillion, and it wouldn't have to move more than once every year, once every decade, right? The underlying asset doesn't have to move. There are applications of Bitcoin. Do you look at how many times my stock has been traded in the past 18 months? Do you know how my stock was traded today? Today, there are MicroStrategy calls, puts, the spot market, the converts, and the junk bond. They're all trading all the time. They're Bitcoin derivatives, right? Just like BITO is a Bitcoin derivative, right? Just like, Block is a Bitcoin derivative. Every single time one share trades hands, Bitcoin moved. So you could say it's low velocity. What I would say is Bitcoin could be a $100 trillion network without a layer 2, without Lightning, without any higher speed transaction network. It could be 100 trillion just based upon the use case as a treasury asset. Let me ask the question, how fast do blocks of granite underneath Manhattan move? How often do you have to move a city block underneath a building in New York City in order for New York or the land to have value? The point really is the foundation doesn't have to move. The foundation just has to exist, right, for it to create value. So I think that the transaction argument is wrong on a number of bases because people don't understand the use case, which is, I just want to hold $5 billion of Bitcoin for 100 years. And every single time I pay an employee, that's Bitcoin derivative, right? Everything that MicroStrategy does is now resting on a foundation of Bitcoin, just like that building stands for 100 years on a block of granite in Manhattan, and everything that comes in and out of that building was predicated upon that block of schist not moving. I buy a ground lease in London, and the lease is good for 300 years. And then I read in the newspaper that some judge found the lease to be non-constitutional and he revoked it, and the tenant lost their building and lost $1 billion because the ground lease is only good for 27 months. And then someone calls me and says, oh, well, we fixed that, not to worry, that judge retired and we don't think anybody else feels the same way. How long as an investor do you have to wait before you would feel comfortable going back and investing on that property? I think that 10 years is a short period of time. Like Bitcoin has been sitting with the same exact protocol for 10 years. And after 10 years of beating on it, then you went through the fork wars. If the original protocol had not won the fork wars, if they had not run the block size wars, it probably would have restarted the clock another 5 years. Right? That the fact that the big blockers lost and the small blockers won meant that you could say, well, it looks like the protocol is pretty anti-fragile and nobody can change it. And that's why I would bet $1 billion on it, or 10 billion, right? Or my life, or my career, right? Or my reputation. If you look at these things, I would say, before you put your weight on something, before you trust your life to it and all your assets to it, you need to be pretty sure. If you said to me, here's a protocol, it's indestructible, it's property, nobody can control it, nobody can change it, I would say, well, how long has it been unchanged? You say 36 months. Like, I think I'll wait another few years. Okay, 10 years. Well, like, now we fought over it, hundreds of billions of dollars were at stake, 10 years. Where are we at now? Oh, now we're risky. Now we're at the point where a company, where a controlling shareholder who's the founder of the company with more than 50% of the voting stock, after going through contortions, can maybe, right? Do you know what it cost me to buy Bitcoin? To pay $250 million in a Dutch auction to be able to buy $250 million of Bitcoin. That's what it cost you after 12 years of an unchanging monetary policy that survived the block size wars. Okay. And that was risky. Now it's less risky. The point is, if you're trying to build on Manhattan, someone said, well, we're going to shift it slightly. You know what we call slight shifts in the foundation of a city?
Earthquakes.
Earthquakes. We call them earthquakes.
1 point for Ledger.
A profound difference between building a company and building on a property. If you're building on a property, what you want to hear is there hasn't been an earthquake in 100 years, and it's going to be the same in 100 years. And then all of the bells and whistles, we build on the layer 2 and the layer 3. Right? The innovation is going to be in Square Cash App. It's going to be at Binance. There's plenty of innovation. You want innovation? Look at FTX. Very innovative. The key question here is we use decentralization. We used a decentralized crypto network to create a global non-sovereign property. You can also use it to create sovereign property. I just gave you the example: China coin, Canada coin. Can you use it to create other things? Can you use it to create cryptocurrency? I don't know. We'll see. Right now, cryptocurrencies are digital currencies, and they're run by organizations, and there's regulatory compliance issues. What are the compliance issues around applications? Right? I mean, there's a lot of great applications. The issue becomes one of what are companies good at? Companies are good at compliance. They're good at hiring an army of lawyers in order to figure out circumstances under which it is legal to offer life insurance in Massachusetts, right? It's a complicated issue. Will that be solved with a DeFi? Maybe there'll be a gray market thing, but it's going to sit in this non-compliant gray market zone. And the rest of the use cases, they all are going to be competitive. They're going to compete against centralized companies. Right? If you read the Crenshaw memo, it's a memo written by a commissioner of the SEC, one of 5, Caroline Crenshaw. If you read the memo, it's specifically on DeFi. And it's pretty clear what she's saying, which is we know DeFi is well-intentioned, and we can understand the appeal of having a high-speed, high-velocity way to do finance. We also understand that there are organizations and development teams that have to configure these things, and they have a lot of power over it. And even though you're well-intentioned, it doesn't absolve you of the obligation not to abuse the investor. the retail investor. The takeaway from that is, look, there is an idealistic future, but there's also the scourge of boiler room, penny stock, pump and dump schemes. And just because you're an idealist pursuing the future, it doesn't absolve you of responsibilities to fair disclosure and fairness, and not to abuse retail investors. And there's an ethical, long before the SEC Act of 33, there are some simple ethical rules, like do not lie, cheat, and steal. Okay, so forget about SEC laws. 10,000 years ago, there was rules like do not lie, cheat, and steal. And then if you read the securities laws, they kind of convert do not lie, cheat, and steal into a bunch of expectations. And along with that has come some good, has come some bad. The bad is, and I'll freely admit, it's too expensive to come public. It costs you $10 million a year of overhead. There's no way to quickly issue a public token. The government says, they say you got to be a bank to issue a stable coin, but they won't let you be a bank. They say we want a bank to issue stable coin, but Facebook found a bank, Silvergate, and then they had to drop DM. Why? The crypto community has got that issue. But the other side of the coin is, if you give somebody $50 billion of chips and you take it and you use it to speculate on Dogecoin and you lose all the money, right? Then there's a run on the bank and people lose $50 billion of US dollars, but they thought it was stable, but it wasn't stable, right? There's a problem with that, right? And there's concern. And so I think that's going to have to get sorted out, and it's a long, long road.